biggest financial scams, and what they teach about risk management. How do billion-dollar financial scams happen? How do regulators, auditors, and boards fail to detect problems for years? And why do intelligent investors lose money again and again in such cases? The truth is, financial scams are rarely sudden. They build quietly. Behind every major financial scandal, there is a story of ignored risk warnings, weak controls, and excessive confidence. Today, we are not discussing gossip. We are analyzing what financial scams teach us about risk management. Because every scandal leaves behind powerful lessons. Let us understand them. If you study major financial scandals across countries, you will notice a pattern. First, rapid growth. The company shows exceptional returns. Investors become excited. Second, lack of transparency. Financial disclosures become complex. Questions are dismissed. Third, weak internal controls. Audits fail to detect irregularities. Governance becomes symbolic. Fourth, overconfidence at leadership level. Warnings are ignored. Risk teams are sidelined. Finally, exposure. When reality surfaces, collapse becomes inevitable. Scams are not only about fraud. They are about breakdown in risk management. When risk oversight weakens, manipulation becomes easier. One major lesson from financial scams is governance failure. Boards are responsible for oversight. Risk committees are meant to question aggressive decisions. Internal audit functions are designed to detect irregularities. But in many scandals, governance becomes passive. Directors rely excessively on management narratives. Risk reports are treated as formalities. Escalations are delayed. This creates an environment where concentration risk, accounting irregularities, or excessive leverage go unchecked. Risk culture weakens when questioning is discouraged. And without challenge, overconfidence grows. Strong governance is not about structure alone. It is about active oversight. Another consistent lesson is excessive risk-taking. In pursuit of rapid growth, institutions sometimes ignore exposure limits. Leverage increases. Borrowing rises. Complex financial structures are created. Everything looks profitable during favorable market conditions. But when the environment changes, vulnerability becomes visible. High leverage amplifies losses. Liquidity pressure increases. Confidence declines. Financial history repeatedly shows that uncontrolled expansion often precedes collapse. Risk appetite discipline is ignored. And when risk exceeds capacity, failure follows. Most financial scandals show warning signals long before collapse. Unusual profit patterns, frequent refinancing, related party transactions, aggressive revenue recognition. But these signals are often overlooked. Why? Because during growth phases, optimism dominates caution. Investors focus on returns. Analysts hesitate to question. Internal teams may fear escalation. Risk management depends heavily on transparency. When transparency reduces, risk increases. Early warning signals are valuable only if acted upon. Ignoring them converts manageable risk into systemic crisis. So what do financial scams teach us? They teach that risk management is not optional. It is foundational. They show that governance must be active, not ceremonial. They demonstrate that rapid growth without discipline creates fragility. They remind us that risk appetite must be defined and enforced. And most importantly, they prove that transparency protects trust. Financial systems operate on confidence. Once confidence erodes, recovery becomes difficult. Scams are dramatic events. But behind every dramatic collapse lies a simple truth. Risk was visible, but ignored. Organizations that respect risk survive. Those that dismiss it eventually pay the price. That is the most important lesson from every financial scandal.